Hello, everybody. Welcome to another edition of our Mosaic podcast. My name is Mandisa Zavala, Head of Asset Allocation from Alexforbes, and I'm joined by the beautiful Mpomole Piane, our Chief Economist. Thank you for joining us for another edition. We're here to unpack the beautiful year that we've had so far, Mpo.
Oh, wow, are we really going with that? Beautiful, yeah.
I'm trying to manifest a much better year
Okay, all
for
right,
the end of
okay,
yes.
okay. We are
Yes.
manifesting.
Yes.
All right, awesome. Thanks, Mandisa, for yet another what I hope will be a great discussion as we hit
Yes.
the halfway mark. We are indeed now beginning to think about what the second half of the year has in store for us. But perhaps we can just briefly unpack what the first half of the year has entailed. And really from the macro side, it has been quite interesting. I mean, we started off the year expecting that growth will continue to hold up well amid falling inflation and interest rate environment, right? But that Goldilocks environment we were expecting was disrupted by the breakout of war in the Middle East, which essentially resulted in the closure of the Strait of Hormuz, a major choke point, right? And putting at risk about 20% of global oil supply, right? And at the back of that, we did see quite a significant increase in energy prices, as well as the price of other commodities as well. Like fertilizer prices. And that also started creeping into the macroeconomic data. So we did see inflation picking up in major regions. And what that essentially meant was that central banks turned somewhat hawkish. So, starting the year from we're expecting interest rate cuts to central banks, essentially saying that no, we may have to start hiking in this environment. And that, essentially culminated with the European Central Bank, for instance, hiking policy rates by 25 basis points at the June meeting. The Bank of Japan also hiked by 25 basis points at the June meeting, but their hiking is a lot more nuanced. Expectations was that the BOJ is going to be hiking this year, even at the beginning of the year, right? Because they continue to normalize monetary policy following years of negative interest rates. But other major central banks, for instance, like the Bank of England, they didn't hike. But what was quite interesting was that two members also preferred to hike policy rates, right? So a massive change in terms of the forward guidance as well. Perhaps what was more interesting is the Fed expectation and the Fed communication. Firstly, we have a new Fed chair, Kevin Walsh. What was quite interesting with his first presser was that, yes, he, sounded a lot more hawkish on inflation. And we can certainly, get into what our expectation is with regards to the second half of the year, but certainly a lot more hawkish, with the market expecting that the Fed is going to hike. But that outlook is a lot more nuanced. What was perhaps also interesting with the Fed meeting as well was that you had 9 of the 18 committee members signaling that, given the macroeconomic backdrop of the U.S. economy, given inflation dynamics, given growth dynamics, as well as employment dynamics, some members are of the view that interest rates may have to be lifted. So quite a significant turn relative to the beginning of the year. Like as I mentioned, we started off with this Goldilocks outlook that inflation will continue coming down, interest rates will, continue coming down to some extent, to now, some central banks have actually hiked, and some are warning that more hikes may have to come. So certainly quite a massive change in the macroeconomic backdrop we saw in the first half of the year. I'd certainly be interested to see from a market perspective what were some of the major themes.
Yes, Paul. I think it was more of the same, actually, on the market side. We also started off quite optimistic. We were thrust into 2026. From quite a tumultuous 2025, if you recall how we were on and off again on tariffs. And finally, we were getting some kind of stability in the market. We were hoping that, with the tariff case now being in the U.S. courts, that was going to be overturned. So there was quite a bit of expectations that were in the market that were for a good environment, essentially, or a good enough experience. I think to kind of just point them out, one of the things that was quite critical, especially given the previous year, was that we had seen a do away of US exceptionalism. And so it was one of the themes that we were already starting to talk about, that perhaps this is now going to be a multi-year theme where we're seeing flows move out of the US into European markets as well as emerging markets. And so no one had on their bingo cards that we'd actually be sitting here today where we actually are seeing an environment of some kind of US exceptionalism. Definitely not back to the way that we had seen US exceptionalism play out before, but there is some level of it that's starting to play out. And so, yes, I mentioned the fact that we were doing away with exorbitant tariffs. That was likely going to be stimulatory towards the consumer, because now you have also, there's some tax cuts that are coming into the system. So we were actually expecting US growth to be more or less robust. But what that meant as well is now you have the Fed coming back to put fresh new cuts into the system that's likely going to prop up earnings. So we were starting to get excited about US small caps. In fact, we had upgraded them at the beginning of the year. And all of these things were culminating to an environment that looked quite good for some sectors within the US and outside of the Magnificent Seven. So we were not calling an AI trade for the US. But like I said, subsequent to what has happened with the war, we've actually seen money flow into AI. We've seen a lot more capex come through on that front. And so there's much larger expectations of earnings going forward. The other theme that I think perhaps has not necessarily changed, but it's shifted in how it's played out, has been the emerging market theme. Yeah. So when we entered into the new year, we were still expecting some returns, in fact, strong returns to come through from emerging markets, because we had started to see the tech theme playing out in EM. Because US wasn't favored, we saw the flows of money going towards EM when you were looking for tech. How this has sort of played out subsequent to the war and fears around inflation is that there's only been key markets that have actually benefited out of the flow into EM. And these are your obvious South Koreas, your Taiwans, that have actually seen very strong earnings revival, strong earnings, trailing earnings, actual earnings, but also expectations as well. But there are some emerging markets that actually have lagged. One of them, being South Africa, which was one of the best performing last year, which actually ended up not being such a great performer. So it's like what we expected versus what is the now or the reality is stark in some way or another. And I think to your point, what has been key for markets has been, what will the Fed do? Yeah. Because once the Fed starts to talk hikes, that becomes problematic. And perhaps it's important for us to then look at that, because I'm not going to be able to talk about an outlook until you tell me what the expectation is on will they not, this Fed dance that we're getting into with our new Fed chair Wash. Yeah. And then a few words, I must say, what a short, straight to the point, short commentary. Straight to the point, making us all do our homeworks now.
Yes. The Fed is no longer going to be telling you where interest rates are going.
Exactly.
He's literally, taking us back to school and making us do a bit of homework, right? So that's a nice segue that we can get into with regards to the outlook. And before I talk about, our expectations for monetary policy, which is, essentially key driver of the macroeconomic backdrop, let me talk about, some of the underlying drivers. Yeah. I mean, listen, let's talk about oil, right? Because, I feel like the previous, 5 podcasts have, just been about oil and the Middle East situation and, how the supply disruption, even because one of the things that we were talking about was that even after you've seen the Strait opening, given how, the technicalities of getting back to pre-war production levels, that's likely to take time for oil prices to come down, right? So the reaction we've seen in the oil market has been surprising to us. I mean, like just think about this, right? So oil prices, dated Brent, peaked at about 144 US dollars a barrel in early April, right?
Sure.
And can you believe it when I tell you that this morning, when I was looking at the data, it was trading at 68 US dollars a barrel. It has more than halved, right? All prices have more than halved, and dated Brent in particular is below that $70 a barrel level, right? And this deceleration in oil prices has happened even before we started to see a normalization in oil production, right? So, all the factors that we were saying about, oil production is going to take time to normalize, traffic through the strait will take time to normalize. All those factors remain true. They have not changed. But what has been a key change has been what's happening on the demand side. So earlier on in the war, we also did talk about demand, that, the type of the supply shock could necessitate a demand destruction, right? But this is not demand destruction that we were worried about, that we are seeing. What we actually seeing is that China has decided to stay out of the market, so they have reduced the oil imports, and given that reduction, it has brought down oil demand. And as a result, your demand and supply dynamics essentially, are always say, let's take it back to equals one-on-one, demand and supply. So the dynamics in the market really, like, we've shifted from worrying about supply shortages to now talking about a supply glut, right? Because of the significant amount of, reduction in demand that we're seeing from China. So, firstly, that is a starting point. What does this mean is that, we've seen a much faster deceleration in oil prices. We can't ignore it. As much as we're still worried, that supply will take time to normalize, we also have to take into consideration that demand has been a lot weaker. Because of China. That also poses a lot of questions, right, with regards to what does this mean for the oil outlook, essentially. What does it mean for inflation and monetary policy? There are some uncertainties, I must admit. Firstly, we don't know when China is going to come back to the market. We are also worried about a potential re-escalation in the fourth quarter of the year post US midterm elections. So what we're essentially saying is that if we do continue to see oil prices at least at the 70 to 75, it's still lower than the 85 target we were previously talking about for year end, right? So that's the one key consideration, is that faster deceleration eases inflationary pressures and alleviates pressure on central banks to at least continue hiking. You'd also recall last month, when we were talking, we were beginning to worry that the monetary policy cycle may actually have to turn a lot more aggressive. We were beginning to worry that we may have to add additional hikes. So what we're saying now is that, we've seen a much faster deceleration in oil prices. We have to take that into account. Yes, there's uncertainties, but definitely this alleviates inflationary pressures. And if anything, we are beginning to consider the other scenario, which we had taken off the table, that oil prices could go back to 60 to 65, right? Sure. And in that scenario, we would actually have to, bring back cuts to the table as early as the fourth quarter of this year. So that's where things stand. I think the most important thing, though, is that, as we were saying earlier on, even when the war broke out, is that this is likely to be a mild monetary policy tightening cycle. And that has certainly been the case, right? And if oil prices continue to fall, some central banks can even get away with not having to hike, right? So, which is positive for the overall macroeconomic backdrop, because that suggests that monetary conditions are unlikely to constrain growth to such an extent that we see a faster deceleration in growth, right? The key question mark remains the Fed, as I indicated earlier on, that, the Fed, the new chair came out a bit more hawkish with regards to inflation. But I think where we differ with the market is that Kevin Wash, his views on what causes inflation, it's a bit more nuanced. He's of the view that the large Fed balance sheet is inflationary. So that would, suggest that he does not necessarily think that interest rates will bring inflation down, right? Like the medication for bringing inflation down may not necessarily be higher interest rates, because if he's saying that it's a larger Fed balance sheet that is leading to inflation, then to bring inflation down, it means that we, then you reduce the Fed balance sheet, not necessarily tightening policy rates, right? So it's a lot more nuanced. The other nuance as well is that while the some members showed that policy rates may have to be increased given inflationary pressures, what we also have to take into account is that when those forecasts were submitted for the June meeting, it's likely to have been before the memorandum of understanding was signed and before we saw this fast deceleration in oil prices, right? So I wouldn't be surprised if those forecasts are also walked back. In recent days, Kevin Wash has also come out to say that the deceleration in oil prices has eased inflationary pressures, and even at the press conference he also mentioned that, to say that those forecasts were submitted with a lot of humility, given how uncertain the environment is and given how fluid that situation is. So to wrap that discussion up, Mandisa, I know I did say quite a lot, but to wrap that up, essentially what we're saying is that we think there's less pressure for central banks to continue hiking in this environment. Yes, we are cognizant of risk with regards to when China comes back, because that could put pressure on oil prices. We are also worried about a re-escalation in the war in the fourth quarter, which could keep oil prices elevated. So if anything, central banks remain quite cautious from here on. Lastly, on the global side, what we are keeping an eye on is the US midterm elections in November, as well as SA local elections in November as well. And really what we'll be watching there in the US was going to be keys, going to be Congress, whether Republicans continue to have control of Congress or whether we see a split Congress. And if we do see a split Congress, the expectation is that that's likely to constrain Trump, in some sort, and at least lead to less policy surprises, right? Locally, the key focus is likely going to be on coalition dynamics.
Okay, no, that's definitely quite a lot to take in. But I think from what I'm getting from you is the environment looks much, much better than what we've been experiencing for the last couple of months.
Yeah.
And I think that is echoed as well on the market perspective. Although I would probably say there's a bit more jitteriness on our side as strategists than there seems to be on the economic side. I think one of the things that we sort of observed with these last couple of months, the experiences we've had, is that we now have new, fresh variables to work with. Yes, there's some good things like artificial intelligence, strong capex that's come out of there. There's still a wall of money, and markets are climbing the wall of worry. As there's ample cash that's still in the system that markets are still willing to invest. But I think the other thing as well is that we now have new risks as well that were not there in the system, despite maybe the environment likely having eased off on the volatility side. One of these fresh variables that I'm referring to is with regards to the US waging a war on any country, Iran, any country. And you spoke about even the risks of a re-escalation in the second year. Those are things you still have to invest with. Your mind has to still contend with those things even as you put money away. And so for us going ahead, we don't think that you're likely to do away with this barbell strategy of having enough exposure to risk, having enough exposure to defensive assets, because there's fluidity. If a central banker can come out and say, we put these numbers up with humility, it means, as an investor, you also have to be humble in the fact that, you might be wrong. And so we still see this US exceptionalism theme playing out still. I think one of the areas that the market has put in quite a large amount of optimism in when it comes to the US are US small cap companies. I think what makes me excited with your statement on saying we could likely get back to cuts is that makes that opportunity set look even more appetizing. I think in essence the reason why value investors would be cautious about going to the US is most likely because of valuations, because those assets are deemed to be massively expensive. But if you strip that away, outside of valuations, you've actually got a stimulatory environment in place for asset classes to do well, barring any adversity that might happen, of course. So we still think that there'll be some form of US exceptionalism that plays out. I think the AI theme, there's a lot of optimism that is being priced into the AI trade in the US. And you see it, there's reasons for that, which we can't unpack in this part. We don't have enough time to unfortunately unpack it. But I think there are some justifications to that. If you're having capex spending to that extent, and also there's validity to us, having AI in this year over the next couple of years. I know there's other debates that are going on from a social perspective and all of that. I think that's that's another story to sort of tell. My biggest concern is not in, can this make money going forward? I think my biggest concern is when does policy become restrictive and problematic? And there's one aspect of policy where you could look at policy from a monetary policy perspective, but you could also consider regulation. I think one of the things that's been very problematic for tech historically has been regulatory risk. And I do not think the market is taking that into account. It's a small risk, so perhaps they're justified in saying there's no regulation risk at the moment, so let's shy that away. But I think you kind of need to be, which is why I'm saying put some money in, but also be prepared that there could be very violent turns and violent shifts if anything goes wrong. Whether that be we expected 10% and we got 9.5, the market doesn't react kindly to that. I think the other area of opportunity is still emerging markets, and unfortunately, what we are being given now, what the famous words of asset allocation is in the saying, diversification is the only free lunch. That's literally what you do as an asset allocator, then your work is done. But the reality is we cannot actually exercise this free lunch, unfortunately. We don't have the free lunch of diversification because we're all concentrated into one major theme, both developed markets and emerging markets, which means I guess that's where you now go to other regions to now kind of get exposure to other. But again, we don't have time to explore that in the podcast. But EM, also very strong AI trade coming through them. And I think it still continues to benefit. So with a lot of the jitteriness that I've spoken about, the uncertainty that I've spoken about, we are also quite positive as well going forward, especially if the current environment holds as it is. With that said, perhaps we could switch over to South Africa.
So from the SA side, the breakout of war is actually quite unfortunate. So like when we look at first quarter data, it suggests that the economic momentum and recovery in growth was continuing. But unfortunately, with higher fuel prices that we saw, particularly in the second quarter of the year, that did lead to inflationary pressures, and the SARB did hike. But what's also quite encouraging is that on the fiscal consolidation side, Treasury remains committed to stabilizing debt. And we also saw that stamp of approval from several rating agencies as well, right? So, that's positive. Even with the fuel levy relief that Treasury provided, that's unlikely to derail the fiscal consolidation story. So that's positive. It also suggests that the upcoming medium-term budget policy statement in October is likely to reaffirm that commitment to fiscal consolidation. I think, most importantly, is the inflation and monetary policy outlook. As we indicated earlier on, that the faster deceleration in oil prices is positive, And similarly for South Africa, it should alleviate inflationary pressures. And what it actually does, you'd recall last month when we were talking, we were almost certain with another July hike, right? We don't have the same level of conviction, I must admit, going into the July meeting. And, that's because oil prices have come down quite significantly. If we continue to see that decline and, oil prices reaching 60 to 65, then, certainly the sub can remain on hold. But there are some underlying pressures also that continue to worry us on the inflation side. I mean, when we look at services inflation, it's still running at about 4.7%, which is way higher than that 30% that the sub is targeting, right? And then the sub is also likely to worry about the food inflation outlook. Fertilizer prices tend to be quite sticky. They haven't reacted to the same extent that we're seeing with oil prices. There's also concerns about weather conditions as well, right? So the sub will definitely be in a bit of a pickle when it sits now in July. But I think most importantly, and what's positive, is that last month when we also talked, we were beginning to worry that, we may actually have to now consider a third hike. We certainly see that risk being reduced given the acceleration in oil prices. So it's likely one hike and done. But similarly, we also wouldn't be surprised if the sub does not hike at the July meeting also. So overall, yes, to sum up the macroeconomic backdrop, both globally and locally, the second quarter certainly some bit of a wobble. We're expecting some recovery in the third quarter should oil prices continue coming down. But of course, we are cognizant of the risk in the fourth quarter, either a re-escalation or China coming back, which will also continue to then determine what the monetary policy calculus is. So I think that's all from my side. From your end, I'll be interested to just hear your thoughts around what the second half entails for South Africa.
I mean, South Africa is definitely, it's been quite an interesting case because as we've appreciated, last year it was the best performing, best place to be globally, driven mostly by really gold prices doing really well. So it was driven by one sector, which is resources. And now stepping into this new year, new dynamics, new risks that we also have at the forefront. There's been some paring down and some shifts that have happened really underneath that have given us a very different structure that we're looking at. So to summarize it, I think the gold call is no longer as substantial as it was last year. I think most of the published estimates, I've seen analysts actually calling for prices to come down for gold from this point on. And I think we're going to have to sort of observe that because perhaps that was also on the back of, much more tighter Fed environment. And perhaps maybe now with that being removed, that maybe you get an environment where actually you're not necessarily as afraid to hold gold, which is an unyielding asset. But still, I think there's still an appeal for gold being an inflation hedge, but outside of that, I think there are some constraints that sort of keep gold at bay, and perhaps we don't see that as a key driver in the South African market, especially when it comes to equities. So that's out of the call. The question is, what then drives equities, or is there anything that remains? I think given what we know now in the system, we've already been introduced to one rate hike. You're saying that the expectation is likely that we could get another one, but also very high probability of us not getting any interest rate hikes. We need to now think about an environment where we are back at the beginning of a hiking cycle, or at least a very short, mild hiking cycle. And typically those sectors that do well at the start of those types of cycles are your banks, your insurances, which are actually being punted as the place to be in. We're also seeing some activity happening on the telecom side. There's been quite a bit of restructuring happening on the telecom side, and we're starting to see earnings actually pull through on that side. If you look at the overall picture, and I think this is probably the biggest point to sort of take away from this podcast, is that if you took a bar chart of earnings and where South Africa sat globally last year, just even in dollars, let's remove the rand for a second. What you would not be surprised to see was that SA sat as one of the highest areas where you were expecting the most amount of growth, so earnings growth. So if you were looking at it over the 6-month period, even over the 12-month period, when you fast forward now to expectations now, South Africa is actually lagging even the US.
Sure.
And I think that's a very interesting environment that we're now stepping into. And this is now for, by the way, the earnings picture that I'm pointing at is the second half earnings picture. So from the point that we're on up until the end of the year. So the 6-month earnings profile actually pits SA as less attractive from an earnings growth perspective versus emerging markets as well as versus the US.
Sure.
We haven't been there for quite some time. And I think this does definitely present a form of pivot to say perhaps you want to be less exposed to SA assets, more exposed on the global side. Obviously, that does come with risks on the global dynamic. But again, we do not expect South Africa to do what it did last year in the absence of a catalyst that is not in the system at the current moment. And that would literally need to be a black swan, another black swan that we would need to see. But as it stands right now, with everything that we know, we expect that South Africa is likely going to most likely deliver, low double-digit returns if it does in any case. So our preference is for SA equities. We've paid down our risk when it comes to SA bonds. I think the compensation that you're getting with regards to the yields there is not as high as it was before. SA ILBs, is, at least on the short end of the curve, served well in protecting us in an environment where we're expecting inflation expectations to tick higher. So I think that is still a trade that you can still have in your portfolio, but mildly so. And unfortunately, with interest rates going high, it does make cash look a lot more attractive. But still, we like equities on a risk-adjusted basis going forward. And I think one of the last things that I'll mention with SA, at least in the next in the second half, is that it will be contending with political risk.
Yes.
And I think the political noise, we have seen it impact the outlook, especially for global investors going forward. It may not necessarily be true from an earnings side, so earnings may not necessarily be impacted, but I think the sentiment towards South Africa does become impacted.
Yeah.
So I think the next couple of months is going to be interesting for SA. And yeah, for the first time in a few years, we're sort of pulling back a little bit to being a bit more cautious on SA.
Yeah, I must admit that's a bit of a change in our stance on SA. I think we've been quite constructive on South Africa, but just given some of these underlying changes in the fundamentals definitely warrant some cautious optimism or a cautious approach. Yeah. And with that, we wrap it up. Cheers.
Take care.